Taxes suck. There's no doubt about it. That's why it's a good thing you have someone like me to break down how the tax rates work with a 401k, a traditional 401k, and a Roth IRA. We can answer that question by understanding a couple simple facts here that we're going to outline. What is the important thing at play here? To get to the bottom of it, it's right here. Tax rate at contribution versus the tax rate you're going to have at withdrawal. There's all kinds of noise around these accounts. Good noise, important noise about how these accounts work. The 401k, you're gonna put money in up front. You're gonna get a tax benefit based on that contribution. And then when you withdraw it in retirement, it's going to get taxed as ordinary income at that point. It's going to go into your pool of taxable income, anything you take out. The Roth IRA works like the reverse, or works in reverse. You don't get a tax benefit up front, meaning you're gonna contribute after tax dollars to your Roth IRA. And then that gets to grow tax-free for the rest of time. Once it's in your Roth IRA, the investment growth does not get taxed when you withdraw. There is a huge psychological benefit to that. I don't want to undersell that. The Roth IRA has that going for it. Once that money's in there and once it's growing, the number you see in your account is what you get to withdraw as long as you wait till the withdrawal age. So what do we want to actually be focusing on whether one of these is better than the other to be investing in? Now, set aside the idea, for at least my opinion, that you should have both because there is utility for both no matter what situation you're in. But we want to understand on a case-by-case basis, when does it make sense to contribute to one versus the other? And that comes down to the tax rates. The tax rates are going to be driven by taxable income. So that's what you need to be dialed in on. If you can project your taxable income both in the current year or in some future year when you're making this decision, and then your retirement in any useful fashion, you can start to drill into these accounts and what makes sense for you. So with our example here, again, let's say our taxable income has put us in a spot where we are paying 22% in tax when we contribute. So if we're just using simple numbers, let's just throw something up there. Let's say 10K goes here. You invest 10K there, you're gonna get a tax deduction that essentially saves you $2,200. In the reverse case, that you're not going to get that benefit, so we're actually going to subtract that amount from what goes into the account eventually. That's going to be 7.8K. So you can see the difference. You get more money up front that gets to grow, but you're going to get taxed more in the 401k versus the reduced amount up front that grows tax-free. What we need to target is that tax rate at the withdrawal period. How easy is that? Not easy at all. How are you going to project out 20, 30 years down the line what your income tax rate is going to be? But that's what we're talking about, right? The more accurate you can get with that, the more granular you can get with these decisions about which one it makes the most sense to. If you're making any decision between the two, having a grasp of this picture is going to help you immensely. So let's just do a little simulation here. Let's say we're projecting 25 years out of retirement just to make this decision. We're going to say in retirement, our tax rate's actually going to go down. We're going to fall a tax rate. Let's say using the current tax rate is going to be, let's move that over, that's way too far, 12%. What does that relationship mean for which one's better? If you're getting taxed more here and less here, then this was a great investment, the 401k. You bypass the 22% tax here with that $10,000 investment. It grew. When you take that $10,000 out, it's getting taxed at 12% instead. You save 10% on what you possibly could have been getting taxed on there. If you're making that decision in this case, the 401k is going to give you a bigger benefit because in the Roth, you allowed that money to be taxed at 22% in the current year. Now, let's reverse that, and let's just even say you climb a tax bracket, 24%. You can see how easy that relationship is to understand now. It's not hard. This is greater than that, meaning that Roth IRA contribution is almost certainly going to be a more beneficial thing because where you're saving 22% now, you're going to get taxed at 24% on that same amount later. This is the factor to consider. Do I think I'm going to pay more in tax on that amount later in life than I did when I made the contribution in the current year? There are many more factors at play. We've already talked about that. You need to understand a lot about other parts of your income picture, about what makes you happy, about whether that tax-free investment growth is really important to you. Just having that psychologically, knowing you can look at that account and not have to worry about taxes again, it's a great thing to have. But this is the decision. if you want to get granular on this decision, really think about it year to year, this is the relationship at play. Can I invest now in a way that's going to be tax beneficial for me down the line? With this in play, that's your decision. 401k, traditional 401k, traditional accounts in general, if you're going to pay less in taxes later, great choice. If you're going to pay more in taxes later, maybe slip it into the Roth IRA. Great to have both. This is how you can decide between the two. Hopefully you have enough income where you can push both of them forward. There's great advantages to both. There's additional advantages to both. Once we get into a more detailed picture, we'll get into in later videos. But start to assess these things and you start to get a clearer picture on how it makes sense to invest your money.